Good morning and welcome to this Money Control live stream, the penultimate trading session of 2025 and of course Nifty's last expiry day for 2025 as well. Week didn't really start on a great note. Bulls not really looking like they are in the mood to party. In fact, they have been fairly subdued. Yesterday we broke below the 26,000 mark. Even 25,950 was taken out on a closing basis. But it's thin holiday trade, so the moves are pretty measured, so to say. Even a little bit of selling kind of leads to a large kind of move on the index, which is evident in the fact that the mid cap index was down somewhere around 0.3% or thereabouts. But if you look at the advance decline ratio, that was fairly poor. The Nifty small cap index was also down 0.6%. But yes, it was the breadth of the market that was extremely poor. But yes, it is holiday thin trade. So any move seems to be large enough for the index to move. A triple digit cut on the index, not how one would have wanted the last week of 2025 to start off. But let's see how things proceed. Today also not looking all that great. The GIFT Nifty hinting at a negative start, a 30-point cut on the Nifty. That's what we can expect. Even in the pre-open session, we can see that the Nifty, in fact, was trading down by somewhere around 20 odd points or thereabouts. In terms of, something to talk about, headline indices and markets, equity markets aside, all the action seems to be in the precious metal basket, right? The likes of gold, silver, platinum, all of these precious metals have seen a fair bit of correction. Mind you, yesterday, silver crossed that $80 per barrel, per ounce mark. For the first time, hit a record high, $83. I think that's what it clocked. But then it came off significantly from those highs. In fact, it came down to levels of $70 as well. So 15% correction after hitting a record high. Extreme swings when it comes to silver prices. Now it's back to somewhere around $73 or so. Some buying coming in Asian trading, but wild swings coming in on prices of silver. I think it was the worst day for silver since 2021. So that's the kind of move we are talking about when it comes to precious metals. Of course, holiday thin trade, people coming back from Christmas holiday and some bit of profit taking after the kind of sparkling rally both silver, gold have seen. Even gold was down somewhere around 4% yesterday. Platinum also corrected a fair bit. But in Asian trading, we are seeing some buying. Crude, on the other hand, rose somewhere around 2%. Of course, there is flaring tensions in Yemen, and of course, the peace talks between Russia and Ukraine. That seems to have had a fresh setback as well. So all these contributing to a rise in crude prices as well. But lots to talk about. We'll take stock of how 2026 is likely to pan out for the market. We'll be getting Jay Thakkar of ICICI Direct, and he will be sharing his top 5 quant picks for 2026 as well, so you can't afford to miss that. And of course, 2025 has also been a year of IPOs, right? But that IPO juggernaut is expected to roll on in 2026 as well. A report by Pantomath Capital has pointed that out, and of course, we will be getting the MD and CEO of Pantomath Capital to talk about that report as well as to how one should navigate the primary markets in 2026. So yes, Outlook 2026, that's what we'll be covering on the show over the next 1 hour. So stay tuned, and of course also keep sending your queries. We will try and get them addressed as well. But before all that, take a quick look at the top stories at this hour. Wall Street ends lower, largely dragged by sell-off in technology stocks. The S&P 500 posts back-to-back losses, pulling back from its record highs, while the Nasdaq and Dow shed 0.5% each. Asian markets open largely lower, tracking weak cues from the Wall Street. Nikkei down over 100 points, while the Kospi also remains around the flat line. The GIFT Nifty also suggesting a flat start with a negative bias for the Indian market, and in the pre-open, we are seeing some mild cuts on the index as well. Precious metals retreat sharply, with silver and platinum falling from record highs hit earlier in the session, while gold is down almost 5% from its peak. Crude oil prices move higher on dented peace hopes in Ukraine and tensions in Yemen. Financial Services Secretary expects insurance premiums to decline after Parliament passes a bill allowing 100% FDI in the sector. says insurance regulator will release draft rules on agent commissions, adds that this is not the appropriate time for composite license or open architecture. And Russian Foreign Minister claims one of President Putin's home in northern Russia was attacked by Ukraine. But Ukraine President Zelensky describes the accusation as lies, saying this is a complete fabrication intended to justify additional attacks against Ukraine. This comes with Ukraine hoping for an improved US security offer to end the war. All right, let's take stock of what the cues are looking like this morning. Not great. Global texture is not all that great. We are looking at Nikkei, Kospi trading with cuts. GIFT Nifty, of course, hinting at a negative start for us. Overnight, US also, saw back-to-back weak sessions with S&P 500, retreating from record levels. In fact, it was the AI bubble fears that weighed on technology stocks in the US, the likes of Nvidia, etc., losing 1%. Or so. Yesterday, we had a pretty weak close. We closed below the 25,950 mark as well. Broader markets as well were on the back foot, but the market breadth was quite poor, favoring declines. Financials, meanwhile, managed to outperform with the Nifty Bank index closing near the flat line. But Nifty Bank index has been underperforming the headline indices as well over the last 3 weeks or so. We've seen negative closing, weekly closing coming in for the Nifty Bank index. Metals were one pocket that were fairly volatile, given the fact that in the early session, metals were doing well. They were up somewhere around 1-2% or so, some of the metal stocks. In fact, the metal index itself was up somewhere around 1-2%. But with silver cracking sharply, we saw all these metal counters give up their gains. In fact, the likes of Hindustan Zinc, Hindustan Copper, which have been hitting 52-week highs on a consistent basis, those stocks also came off pretty significantly from their highs. FMCG saw some buying interest in a weak session. Tata Consumer, Asian Paints, these were among the top gainers. But railways, they reversed some of the good gains that they saw on Friday. In fact, although cuts were fairly sharp on railway stocks, but if you look at the monthly gains, fairly good. They are still clocking in gains of 8-9% on a monthly basis. Lots of other pockets were also in focus. The likes of EMS, they also saw weakness. But let's talk about the fund flows as well. Selling continues unabated. FIIs were net sellers to the tune of 2,800 crore rupees in equities. I mean, one would say that perhaps the selling would abate given the fact that it is year end. People would be on a holiday. But, the figures are saying a different story. 2,800 worth of selling coming in from FIIs once again. DI net buying continues. That has been a pillar for the market. 2,650 crore worth of buying coming in the cash market by the domestic investors. Put call ratio fell further to 0.68 vis-a-vis 0.76 in the previous session. And Saman Capital is one stock that continues to remain in the futures and options band. But on that note, to take stock of the technicals and to understand what to expect in 2026, let me bring on board Jay Thakkar, Head Derivatives and Quant Research at ICICI Securities. Jay, lovely chatting with you. Penultimate day of 2025, last expiry for the Nifty for 2025. Yesterday wasn't a great session. 26,000 was taken out. Doesn't look like bullseye in party mode. What are you expecting over the next 2 days?
Hi, very good morning to you, Nandita. And first of all, let me take this opportunity to wish you a very, very happy New Year and a prosperous New Year as well. To you, entire team of Money Control and all the viewers of Money Control as well. This year was quite volatile, I would say, not in terms of India which is going up, of course, but then since from the calendar year 24, we saw the correction started and continued for at least the first quarter of this calendar year. I would say the first 3 months, and thereafter gradually we saw the recovery happening in the markets, because of which we saw again a lifetime high in 2025 as well. But then not much to gain from the stocks and sector specific, because the FII selling continued, right, and throughout the calendar year, and we have seen a significant outflow from the secondary market. But as far as these two trading sessions are concerned, coming particularly to your question, I would say India VIX at the lowest levels, IVs almost at the lowest levels, is just that yesterday we saw some 6% kind of an up move in the India weeks and 50% kind of an up move in the IVs from 6 to 9 historical low levels. Nandita, I'm sure there's a very high probability and I mean, very high, the odds are quite in favor of India VIX or IVs going up from here on as we are approaching the Q3 numbers in January point 1 and secondary ahead of the budget. Generally, we see that the IVs go up ahead of the budget or kind of these kind of major events. So I think
Hmm.
IVs going up, India VIX going up. Now, generally, whenever that happens, markets tend to correct, right? That's the first thing. Uh, on the rare occasion, what happens is, Nandita, the IVs go up as well as the market go up, and that happens due to excessive shorts in the system. And if at all there is a short covering by the FIIs, further in the
Hmm.
stock as well as in the index futures, then you can see IVs and market going up both, simultaneously. Else, there could be some further consolidation to maybe a correction as well if the IVs are going to go up. But yes, sector specific moves cannot be ruled out.
Okay, sector specific rules moves cannot be really ruled out, but for particularly for today, since it's expiry day, what are you expecting? What do you think? 25,900 on the downside is at risk?
Yes, I do think so. Yes, see, until we don't see a close now, Nandita, about 26,000 levels, there would be a risk that we might test the lower end of the range again. So, what has been the range for the December series? It has been broadly 25,700 on the low, 4 to 600 points range on the Nifty for December series, Nandita. And we have seen that 26,000 levels time and again has acted as a very, very critical level. I mean, whenever we have seen Nifty going about 26,000 levels, it has moved up by 200-300 points. And whenever it has come down below 26,000 levels, it has slipped by around 200-300 points. 26,000 strike had the was the most active strike for this particular month. Hence, below 26,000, there's a risk of 29,500, 25,900 getting broken.
Okay, there is a risk of 25,900 being broken. Okay, hold that thought, Jay. We'll talk about the best case scenario for 2026 as well, and what are the sectors that you're betting on, and of course your stock picks as well. But let's take stock of the market open first. We were talking about the 25,900 level being at risk. Now we are very close to that level, 25,912. That's where we are at. 25 to 30 point down on the index, but yes, looks like 25,900 is at risk, very close to that level now. On the Sensex, we are down 145 points. Mid cap index also moving in tandem with the benchmarks. Advanced decline ratio, early days to call a decisive trend, but it's still skewed in favor of laggards, marginally so right now, but let's see how things pan out. In terms of sectors, the Nifty Bank index is again on the back foot, moving in tandem with the other indices as well. But in terms of other sectors, let's see what is the texture looking like. All the sectors are trading in the red. So yes, last few days of 2025, doesn't really look like any kind of Santa rally or cheer on the streets. Given the fact that look at real estate pack that has been hammered out of shape. If you look at the yearly performance. And it continues to do so, right? The Nifty Real Estate Index is down 0.5%. IT is down for a fifth straight day, if I'm not mistaken, down 0.3%. PSU banks that were trying to hold on to gains yesterday, even they have succumbed to selling pressure. Autos, metals, pharma, FMCG as well. That was that egged out slim gains yesterday. So all of these indices, are clocking in losses. So hardly any cheer, and one would have hoped that there would be some kind of buying emerging last 2 days, some kind of green on the screen, but that's really not the case. Take stock of some of the top movers then on the index. Eicher Motors, that's the top laggard, followed by Eternal. Eternal Swiggy had a good session yesterday, but once again selling is resuming here. Apollo Hospital, among the laggards, some of these metal names like Tata Steel also under pressure. L&T, Bajaj Auto, Titan as well. They've of course opened their first store on lab-grown diamonds in Mumbai. That stock is down. It hit a fresh 52-week high yesterday. Bajaj Auto, Ultratech Cement, Indigo. That stock has been on a gaining spree of late, but today that stock is also under pressure. On the flip side, Shriram Finance long-term credit ratings have got an upward revision by CARE ratings. That's of course a positive for the company. That stock is up 1.5%. Tata Motors passenger vehicles. Bharat Electronics is also among the gainers. Yesterday, defense stocks kind of fizzled out and had a mixed close after that DAC approval for 79,000 crore worth of proposals to buy weapon systems. But we had a mixed close when it comes to defense stocks yesterday. Today, BEL gaining traction once again. Grasim, Adani Ports, Dr. Reddy's, some of these pharma names also doing well. JSW Steel also among the gainers. Maruti, ITC, Axis Bank, ICICI Bank also holding out. So all in all, yes, not a great start, but yeah, I mean, it's all red across the screen, and that's not really good news. And of course, the advance decline ratio has worsened slightly, 2:3, firmly in favor of declines. But we were talking about the 2026 outlook for the Nifty, Jay. A lot of these brokerage reports I was reading, some of them have said that 30,000 on the charts cannot be ruled out for the Nifty for 2026. What's the view at ICICI Direct? Of course, we know that we could be expecting a short covering rally by the FIIs, and of course this year they have pulled out over $18 billion from the Indian markets. But if the FIIs were to come back, when do you expect that to happen post budget? Is there a particular event that we are waiting for the FIIs to return? And of course, what's the best case scenario at ICICI Direct when you're talking about Nifty levels for 2026?
Sure, Nandita. I mean, the best case scenario which we are looking out for Nifty is 29,200 for calendar year 26. And the reason is definitely, there are two cases which we have taken, in our report, Nandita. So the first case is that, FI coming back, the revival, of the FIs or the inflows of the FIs. And why could that happen? Yeah, I think that, in 26, it's quite likely that we would be having a deal with the US. It's quite likely that, once the trade deal happens, there could be a good 10 to 12% or 15% kind of a move in the index. Nandita, and that is what we have seen happening with the other Asian markets as well. I mean, when you look at the Taiwanese market or Japanese market, South Korean market, I mean, after June, July, I mean, when post their agreement with the US on the tariffs, and when the tariffs were reduced, they made a trade deal with the US. And these markets have gone up by 27%, 40% to 60% as well, right? So there had been a phenomenal run in this, other Asian economies, whereas India could manage only by around say 7-8% kind of a return for this calendar year, and these all other Asian markets in fact delivered more than 25% returns. So that is a very clear indicator that once trade deal happens, that negativity or the negative sentiment fades away, and you get this, there is a high chance that you get FI money back. That is point one. Obviously, with that, the rupee depreciation would also be controlled. I think, post that would be expecting some appreciation happening in the rupee, and whenever that happens, obviously, FIs are going to come back because they would get it cheaper now than later, right? Whenever that appreciation happens. That's point two. Point three, Nandita, is that the rate cuts in the Fed. So we have seen the RBI cutting rates and pumping too much of money through the OMOs, and now we are in the liquidity surplus out here in India, right? So there's not a liquidity problem out here. Secondly, whenever we have seen the Fed rate cut cycle to starting, there has been a flow of money across the equity markets, and Indian markets have always benefited out of it. Last year, particularly, what we saw is that we had seen the Fed rate cut in the later half, or maybe I'm talking about calendar year 25. So this year we have seen it coming in the later half. In the initial quarters, we had seen the quantitative tightening, because of which we had seen the outflow happening, by the FIs. But now, since the cycle has turned there, I think the Fed rate cut would definitely bring the money out here, and that FPI flows will definitely help our market to inch higher. And how could we derive at this 29,200 target if at all we are seeing this money coming back by the FIs? I mean, they until November, from Jan to November, and if I see calculate, then Nandita, almost 1.4 lakh crores is what was the outflow figure of the FIs from the Indian secondary
Hmm.
market, I mean equity markets, right? And that is likely to reverse. We already have the support around the levels of 24,200. That's the average. We say the mean of the on the monthly charts of Nifty. We have particularly noticed that post-COVID era, Nandita, this monthly 20 days held quite well and has not been broken on a closing
Hmm.
basis. So that now going forward statistically proves to be a very good support. Hence 24,200 is seems to be a very good base. On the upside, if you look at 2.5 standard deviation from the mean, right, then those targets would be around 29,200. We statistically have arrived at this target, and the reasons for the FI coming back, as I said, would be Fed rate cut, and secondly would be definitely the likeliness or high chances of US and India trade deal happening in calendar year 26, and that will definitely help the Indian markets to move up.
Hmm. Okay. Quite a few pointers to take note of, and of course, the best case scenario for the Nifty happens to be 29,200 at ICICI Direct. Before I come to your top five quant picks for 2026, tell me which are the sectors that could see more buying action in 2026, because if you look at the IT pack, real estate pack, these are some of the pockets that have really underperformed in the year 2025. Even though IT has staged a good comeback, if you see the last 3 months, there's been no such luck for real estate. And
Yes.
fundamentals are working in favor of real estate in terms of rate cuts happening, home loans getting cheaper, etc. But still, stocks haven't really been able to see traction. So how are you looking at these two pockets for 2026? Because they have really underperformed in 2025. And which are the sectors that, according to you, could be the stars of 2026?
Sure. I mean, well, see, Nandita, I would say that if we focus on the flow of the funds, I mean, despite the sell-off by the FIs to the tune of 1.4 lakh crore until November, we have seen the DIs cushioning the Indian equity markets by the kind of flows which we are seeing to the route of SIPs has been phenomenal, right? And the kind of growth which we have seen, I mean, almost 30,000 crore now per month. If you see, then even if I sell by 2 lakh crore, we'll be having almost 3.6 lakh crore to the root of SIPs. So definitely DIs are cushioning the market, and hence 24,200 remains a very good support. Now, if we understand the flow of the FIs in this calendar year particularly, Nandita, what has happened is, yes, IT was the hardest hit, I would say, sector, along with realty, power, and FMCG. So these are the and of course, thereafter, it was oil and gas sector, I would say, or the energy sector. So the five sector wherein FI focused, as far as the selling was concerned, was mainly in these five sectors, which I mentioned. Whereas on the flip side, if you see, the DIs in fact had a good buying interest in the FMCG, IT, right? And so whatever was getting sold by the FIs was getting bought by the DIIs. That is what happens generally, right, Nandita? Now, banking was one sector which was in focus both by DIs and FIs. So earlier we saw the outflow in the BFSI segment by the FIs, but thereafter we saw the recovery in the BFSI segment as well as far as FI flows was concerned, and DI flows was also positive in the BFSI. So if I have to mark it on a pyramid or a triangle, so on the pyramid, the topmost sector which is likely to perform, Nandita, is going to be banking and financial services for all these reasons, because of the flows which I've just mentioned, which has been neutral by the FIs and positive by the DIs. Point one. So flows is not a concern, right? They have a highest weightage within the Nifty, which is almost 36 to 40% kind of a thing. So definitely, whenever the market comes back, it will chase that weightage as well. That's point number two. And point three is the all the macros which we have seen as far as India specific is concerned, which I just mentioned at the start, the action which has been taken by the RBI, and obviously the finance ministry as well, to boost the economy, to boost the growth. I mean, this is one sector which is right at the top of the pyramid. At the bottom would be these sectors wherein we had seen immense shorts. May it be IT, power, realty, energy, and FMCG. I think these are the sectors which will be at the bottom of the pyramid, which will be seeing a bounce back on account of short covering. As you mentioned, IT has already witnessed that. It has already started, and it is likely to continue as well. And once the trade deal happens, I think the positive sentiment will help the IT stock to in fact even move up higher from here on. Power stocks may also see a good bounce back because we have seen excessive shorts out there, but that these would be just trading ideas. You know, uh, Reality is the one sector which, Nandita, I think that since you asked a question particularly on that as well, so I would say that Nifty Reality is one sector which we think might still face some consolidation going forward, because despite this recovery in the market, despite short covering happening, in fact, last week, if you see, all those beaten down names bounce back. But Nifty Realty, as you rightly pointed out, did not show any such sign of a bounce back. So I think that would continue to be a
Hmm.
laggard as of now, as per the data. Auto is one sector which I think auto and oil and gas is one sector which we think, Nandita, could be a sectors of consolidation now, because we have already seen a good run up. So we're not bearish out there. That would be the middle of the pyramid, wherein you can see some consolidation, right? So auto could be one of those sectors wherein we could see that consolidation, and along with that, it could be capital goods and telecom as well, because we have already seen a significant move coming in the telecom stock, particularly Bharti Airtel, which holds significant 4.5 to 5% kind of a weightage now in Nifty, right? And it's almost more than 12 lakh
Hmm.
crore kind of market cap, right? Which is very near to TCS now. So after such a significant run up, I think there could be some consolidation now out here in capital good, telecom and auto. So that would be buy on dips, right? BFSI would be a clear buy, and all those sectors which I mentioned
Sure.
at the bottom of the pyramid would be a good 3 to 6 months play from the point of view of short covering.
Sure. Taking your point in all the sectors that you mentioned. But Jay, before moving on with the show, what are the top 5 quant picks for 2026 at ICICI Direct? If you can take us through the names and the target prices.
Sure. So as I said that, we are quite bullish on the BFSI segment. So from there, within the banking pie, from the PSU side, Bank of India is what we think could provide a good risk reward and good returns on the upside. We have seen the PSU banking names already outperforming the private sector banks, and Bank of India has an upside potential for almost 30% from here on. We have a target of 180 on the upside. So that's the first con pick. Second would be on Marico. As I said, Nandita, that FMCG could see some good short covering, and that's at the bottom of the pyramid, and it's one of the sector which has really underperformed in calendar year 25. So from here on, Marico is one stock which we think can inch towards the target of 880, and it has got a good upside potential of 21%. In fact, this has been one of the stock wherein we have seen good result and long build up. So it's already outperforming its sector. Second would be Ultratech Cement. Ultratech Cement has a target of around 14,500 and has a good 26% upside potential, Nadita. And if the capex happens by the government as well as from the private sector players, then I think cement would be one of the sector which would benefit out of it. And second would be that post GST, we have seen auto sector really witnessing that clear up move. But despite the GST cut from 28% to 18%, we had seen some profit booking happening in the cement pack. It was a profit booking, it was not short. So I would say after a good long up move, there was some profit booking, and again we have seen an early sign of long build up in the cement space as well. So that would be our third topic. And fourth would be TCS. Now, as I said, we are expecting a bounce back in the IT names which have already started, and since it is at the bottom of the pyramid, that could be a good short covering. And TCS, particularly Nandita, after consecutive four negative quarterly close, this is the quarter. Tomorrow we'll be having a quarterly close, wherein we will be having a positive close for TCS after four quarterly close, which clearly indicates some pause and a bounce back from these levels. And hence, we are expecting around the levels of 37.75, which would be around 50% retracement of the overall fall. And hence, it could be having around set 19 to 20% kind of an upside potential. Last would be Sun Pharma. From the pharma pack, I think the sentiment out there could also be positive once the trade deal happens. And Sun Pharma, after four negative close, has already closed well in the positive territory, has provided a breakout from a falling trend line, have started to see long build up again. And this is one stock which I think within the pharma pack, which has got a good upside potential for almost 23%, and we are targeting 1540 as a target.
Hmm. All right, those stock picks flashing on your screens for 2026. coming in from ICICI Direct. Lots left on the show, but let's take up some viewer queries. But before that, I usually don't respond to trolls. But as we wind down 2025, would really request all of you all to understand that it's a 1 hour show, and queries are just a segment of the show, and it's only pertinent that you give everyone who sends in their queries a chance to get their queries answered as well. It's not about answering one person's queries or two persons' queries. It's a show, and everyone should get a chance. So, that's how the queries are really filtered and taken up. Just because, the anchors are being able to read out your comments doesn't mean that you spread out a lot of negativity. And that's one message that I would want to give our viewers, that, avoid spreading negativity and wait for your turn. We at Money Control, I think we answer all your queries. We make that effort to get them answered on a daily basis. And I think it's a one-of-a-kind show that actually makes an effort to do that. So, appreciate that and wait for your turn. That's my humble request. But on that note, let's take up some of them. We have a query coming in on, I think I saw this query on Axis Cade from Sita Ramulu. Axis Cade, I haven't really seen the chart. Jay, if you've seen it, any thoughts on where the stock is headed? And if anybody has a position on this stock, what they should be doing with it?
I think, see, overall, we have seen, Nandita, that defense have already done good in this particular year. In fact, it had done good since past few trading years and past few calendar years, I would say. But Axis Cades from these levels, I would say, can see some bounce back, at least until the levels of say 1450. But there is a level wherein I think one should be exiting and booking profits if at all someone is holding it for long, because there is a very high chance that the stock is forming a bearish head and shoulders pattern and it would just form a right shoulder. So once that opportunity is over, I think the probable downside thereafter would be even deeper. So 1450 is where it can bounce back until, and around those levels one should be exiting the long positions. If someone wants to bet from the trading point of view, one can do that with a trading stop loss of 1200.
Okay, that's about Axis Cades, but there are a couple of other defense stock queries that have come in. From Naveen on a Mazgaon Dock and Anil on a Bharat Electronics. So, we did see some traction in defense stocks, and yesterday we had that Defense Acquisition Council, approval for 79,000 crore worth of weapon system proposals that came through. So, yesterday we had a day of profit taking, but if you look at the YTD charts of some of these counters, they have still shaved off 15 odd %, right? So, what should the strategy be as one enters 2026? Should defense really be a part of your portfolio for the long term, and for the very short term, would you suggest booking profits on every rally, or would you in fact advise averaging out?
Well, Nandita, I would say that defense could be one sector at least which can be held until the budget, and I'm sure whatever bounce until budget you get in the defense should be utilized as a sell on rise or booking your profits. One should be very, very selective as far as stock specific moves in defense is now concerned, because now it is overcrowded sector is what I think. It's overvalued as well from the short term point of view, not from the long term point of view. Hence, if someone is really looking out for 3, 4, 5 years, then it could be a sector. But if someone is looking for 3, 4, 5 months, or particularly calendar year 26, then I think one should be looking out on bounce.
Okay, that's the call. Let's take up some more queries then. There's a query.
And wherever, but once
I think there's some audio issue out there. Hold on. We're trying to get Jay's audio back. I think there's some problem with his feed. Jay, can you hear me? Okay, there seems to be some internet issue at Jay's end. We'll try and get him back. But in the meantime, let's see what the markets are doing at the current juncture. We are back above that 25,900 mark, cut some of those early losses, so to say. The Sensex is now down over 120. Mid cap index as well down 2/10%. The bank Nifty, that's also down 2/10%. But the advanced decline ratio has kind of worsened. 1:2. That's the NSE advanced decline ratio. I think he's back with us. Jay, can you hear me?
Yes. I hope I'm audible too now.
Yeah, you are audible. So we were talking about defense, but another pocket that's been, or not in favor, you can say, is the EMS lot, right? The likes of Dixon Tech, Keynes Tech, all these companies have stocks have seen a fair bit of sell-off. I can just spot a query from Satvika. She has a query on Keynes Tech. Any thoughts on how one should navigate these two counters, Dixon and Keynes?
LC Keynes is too oversold now, and it has at a very good support of around 3600. So if 3600 levels are held, Nandita, I'm sure that that's trading around 39 to 4000 levels. But after having fallen from a cliff of almost 7000 levels, I think 3600 now seems to be very critical support. And if those levels are held, we would definitely see some bounce back coming at least until the levels of 45 to 4600 on Keynes. And likewise, Dixon Tech too has witnessed a good short build-up, huge short build-up, I would say, in past few months, Nandita, and because of which we have seen this stock falling at least now until the levels of 11,900, 12,000. It still has a downside potential, downside risk of it's slipping down to 10,000 levels. So Dixon Tech, according to me, if breaks 11,800 now, which is just 118 points away, if 11,800 levels are broken, I think it will slip to 10,000. There is where one can exit. Otherwise, wait for 118 points and you can see some bounce back happening until, say, 14 or 1,000, which would be, according to me, an exit opportunity.
All right, that's about EMS. That's how you should be navigating. Keynes Tech, of course, looking pretty oversold on the charts. But with that, we have to cut short this discussion today, Jay. That's about all we have, all the time we have for this segment. We have another guest waiting by, but Jay, would like to thank you for taking out time and sharing your thoughts for the Nifty for 2026, your recommendations as well, and your view on the sector, and of course, helping our viewers navigate their stock-related queries as well on a consistent basis. Thanks a lot for that, and wish you a very, very happy new year to you, your family, and your entire team at ICICI Direct. And I look forward to interacting again with you in the very first week of 2026, if not later. Thanks a lot for taking out time, and wishing you a very, very happy new year as well.
Sure, Nandita. Thank you so much. It was a pleasure talking to you.
Thanks a lot. Always, Jay. Thanks a lot. On that note, let's shift focus then. We've spoken a lot about the secondary market, but there's been plenty of action in the primary markets as well, because India's primary market in 2025 is set to go down as one of its busiest years, marked by strong listing activity, even as performance has varied across issues. More than 100 companies made their stock market debut on the main board this year, raising an aggregate of somewhere around 1.8 lakh crore rupees, and that's according to data from Prime Infobase. But that may just be the beginning. A report by Pantomath Capital suggests that India's primary markets are on the cusp of a major milestone, with nearly 4 lakh crore in capital formation expected through IPOs in 2026. And beyond the headline numbers, the bigger takeaway is this: the IPO boom is no longer cyclical, it is turning structural. So how should investors navigate the primary markets in the new year as this IPO juggernaut rolls on? Joining me now is Mahavir Lunawat, Chairman and Managing Director, Pantomath Capital Advisors. Mahavir, lovely chatting with you this morning. Hope you're doing well. All right, I think your mic is on mute, Mahavir.
Yeah, very good morning, Nandita. Thank you for this wonderful opportunity and looking forward to this very, very timely and useful discussion.
Sure. Let's begin then. Of course, we've seen how 2025 has been a record year for IPOs, plenty of action in the primary markets, and the juggernaut is only expected to roll on in 2026. For investors, the big takeaway here is that IPO boom is becoming structural, not cyclical. Does that mean primary markets are now a more reliable hunting ground for long-term wealth creation?
Absolutely. I think we have come up a long way in terms of, where we were pre-COVID and where do we stand today. So if you compare, pre-COVID 5-year period, I mean, we have made an analysis of a decade so that we can have more proper results rather than just discussing on a year-old number. And I think the way we have scaled up, both in terms of number of issuances as well as in terms of the overall volumes and size, I think we are in for a very, very structural shift, and the markets are getting more structurally resilience rather than being cyclical. And that's, I think, a very good news from capital formation point of view. We are in fact, at inflection point where our country is looking up for next level growth. And I think primary market will play a very, very pivotal role in making our country self-reliant and fulfilling the country's dream of nurturing Make in India in a big way.
Okay, so over 3/4 of IPO money is now going into expansion, capacity creation, and debt reduction, according to that report that you guys have released. From an investor's lens, does this materially improve the odds of post-listing performance as well? What do you think?
Yeah, because I think one of the analysis which we came up with is that while as a percentage still we have more money going for OFS, but as an absolute amount, I think we have made the largest amount in primary fresh issue, which is close to 65,000 crores. That money is going for the corporate balance sheet strengthening and capex cycle. So that will definitely add to the corporate earnings, that will definitely add to the corporate growth, and naturally it will result to shareholder capital maximization. One interesting fact is that while apparently it looks that the OFS is larger or primary is lesser, but if we see the trend over last 1 decade, the primary portion, the fresh issue portion, has been doubled from close to, let's say, 15% to more than 35-40%. And very interestingly, if we go a little detail granularly, if we kind of normalize by adjusting the top 5 issuances, which are of course scaled up companies, investors have put in money at several rounds of capital raise, and they would have probably exited as part of OFS. So if we take that out, I think it's a very interesting trend of fairly mixed primary and secondary, so close to 50%. That's, I think, a very healthy trend of IPOs nurturing the primary fresh raise of capital as compared to what it was probably 5-7 years back, where the primary raise was only 15-20%. So I think we are seeing a very, very healthy trend of more primary. Not that we are averse to secondary. I mean, that of course is a cycle of capital investment. So that's also important. But I think primary raise coming in a very, very balanced way, it's going to definitely give a lot of boost to corporate earnings and growth in those respective sectors and companies.
Sure, point taken, but 3/4 of IPOs listing at a premium, sounds pretty encouraging. But sustained gains, beg your pardon, but sustained gains now seem tied to governance and earnings visibility. You also mentioned that, of course, so many, issues coming out and, companies raising money, it will give a boost to earnings visibility as well. But has the market really matured in terms of how it really rewards IPOs? For investors, is the real opportunity now shifting from listing gains to holding quality names longer in their portfolios?
Very interesting, analogy, Nandita, and I think there are various aspects to it. I mean, one can take credit of saying that IPOs 75% have listed or made a debut at premium. But I think we have to see a little longer when it comes to investing. It's like, sowing a seed, or, how the plant sapling takes shape of a tree. It takes time. Similarly, any corporate, IPO is start of the journey. And but fortunately, unfortunately, I think we are having more trading mindset many a times. So I think we need more investors rather than traders, and the kind of capital formation we look for, we aspire for, and we need. I think we need to give due time to management. On one side, let's say we expect more primary, more capex, more working capital, companies to strengthen their balance sheet, expand. On same time, most of the times, we compare with listing pops and short-term gains, and there have been a lot of coverage in terms of how IPOs have performed since listing this year. But I think it's high time that we basically promote long-term investing and give some time to management and corporates to perform, and then probably take an analysis of 5 years, 10 years down the line in terms of how those companies would have fared. But having said so, I think the good news is that despite a lot of geopolitical issues and a lot of corrections in secondary market, particularly in small and mid cap segment, we have 75% IPOs listing at premium. I'm sure as their earnings will come up in follow-on quarters, they will match up with the future projections and outlook what they have given.
Sure, but Mahavir, a lot of recent listings are also below their IPO price. Of course, barring the likes of Meesho, Growth that have seen very good listing and they are doing fairly well as well. But how should investors really choose? I mean, what are the parameters going into 2026? Since your report has also pointed out 4 lakh crore worth of fundraising by IPOs could take place in 2026. So we are staring at another record year. So how should one really choose these issues and go about investing in them?
So one is, Nandita, there are again 2-3 aspects. One is, taking on the numbers since we mentioned 4 lakh crore, it's via IPO, QIP and all the primary issuances on primary market. So if you see the dry powder available with funds and insurance treasuries, we are sitting with 4 to 5 lakh crores of, dry powder, the undeployed money, which mutual funds, treasuries of insurance, banks and other equity treasuries are having as on date. And on top of that, we are having 4.5 to 5 lakh crores of fresh funds, flowing every year. So we are sitting on, let's say, 7 to 8 lakh crore of undeployed money, which is to be deployed in equities. And as against that, we have seen just probably little less than 2 lakh crore of fresh issuances. So if we do not have sufficient papers, this money will go to the existing, stocks naturally. And we have free float of, let's say, 75 lakh crore, combining the all, free float of existing listed companies. And if 5 lakh crore of fresh funds are coming every year, in 15 years, assuming there is no deployment of these funds, in 15 years, we will actually consume the entire float. So that's the kind of, flows we are faced with in terms of supply of capital. As against that, we are just having probably 1.5 to 2 lakh crores of capital raise over last, 2 years on an annualized basis. So I think the way we look at both from demand and supply point of view, we definitely need to have at least 4 to 5 lakh crores of IPO alone. Now, this 4 lakh crore, what we have given outlook is of IPO, QIPs, and post listing capital raise programs. But IPO alone has to be of 3 to 4 lakh crore to set that equilibrium both from demand as well as supply point of view. Otherwise, what will happen is most of the money, as currently we are seeing that most of the money is going to probably, let's say, top 300 to 350 stocks, and as a result, probably sometimes the valuations hold on even if the corporate earnings do not match up. So in a longer run, if we have to have equilibrium, we must have more and more papers. And country of our size, just giving 100 IPOs in a year, I think we definitely need to have at least 200 to 300 IPOs to match up with the numbers and the demand, as also the growth what we expect as per the outlook. We need to double the GDP in, let's say, next 7 to 8 years. So whichever criteria we apply, whether it's the expected GDP growth or for liquidity available, or in terms of the economics of demand and supply, I think we will need 4 to 5 lakh crore of IPO mobilization. Otherwise, we will definitely have a lot of valuation ballooning up for a few select stocks.
Okay, that was my next question really. What about the valuation math? Because some companies are commanding ultra premium valuations despite not being profitable. How does one ensure that they are paying the right price while investing in an IPO? I mean, that's $1 million question now, because there's so many IPOs and so many good companies as well, but they aren't yet profitable, and the premium valuations that they are commanding are quite exorbitant. So what's your view on that?
So I think again, this is we are in a very matured market. There's a robust regulatory process of discovery of price. Sophisticated, informed investors would have gone through in detail. There are investors sitting in most of such companies which have gone through several rounds of capital raise. And when the price is set, definitely a very, very transparent and fair discovery happens. So in that context, I think one would fairly assume that the price is set as per the demand supply. And particularly in 2025, we have seen a lot of IPOs, sizes getting corrected between the filing as well as filing and the issue launches. So that means what we started with probably it has been modified sometimes significantly based on the valuation appetite and market understanding of the sector and the business. So that is one aspect. And secondly, I think we have just seen probably 6-7 of IPOs of the new age businesses which are probably below break even or just turned profitable. But good part, I think, is that unlike in the previous cycle, now the companies are nearing break even, or they are coming to the market with clear visibility and pathway to break even. So that's, I think, that again demonstrates the kind of investor sensitivity towards bottom line. And I think we will see more and more bottom line focused approach. That's the second aspect to it. And thirdly, I think more philosophically, when we have a lot of technology, a lot of new age businesses appetite, there have been various policy campaigns and decisions to promote new businesses, because I think even from macro point of view, we need to have certain businesses flourished to scale and size domestically. So unless and until we have certain case studies and such businesses going IPOs and public, how those investors will get confidence. So I think it's a complete ecosystem. It will probably be unfair to just have a standalone look at certain listings or certain businesses. But I think good part is that we are seeing more and more those companies coming up with profitability pathway, and investors understanding those businesses. I think again as our analysis goes for the overall sector, we will need more such businesses to get onto public, so that we have grounds up approach and we have more and more wider these businesses getting flourished and built to scale as we go along in, let's say, next 5 to 10 year period.
Sure. And in terms of the key red flags, then what is it that investors should watch out for? Governance, aggressive pricing, business models chasing valuation rather than earnings. I mean, any red flags that investors should be mindful of before investing in an IPO?
Yeah, I think my personal view I always share in any forum, and happy to make use of this platform, Nandita, is that IPO is not a short-term investing, and still even in today's informed arena, we have many of people investing based on the informal messages and hype. So I think we have come up a long way in terms of regulatory disclosures, in terms of investor-friendly disclosures. We have audio visuals, getting created officially for any offering. So I think we have come up a long way in terms of making investor aware, in terms of what one should look at, and how we can make those disclosures, user friendly and in a very, very easy manner. So in that context, I think one should be very, very, mindful of the risk factors, the business, outlook, what one has given. So that's one aspect. And second is that uh, the traditional metrics always hold good in my view. So sometimes, corporates having conflicting business models, family members not being aligned to the current business, which is being taken public, too many related party transactions in the past, auditors' observations on the balance sheet and transactions. So these are, I think, age-old, governance principles, which are, of course, fairly, described in the offer document. But I think one must look at those, disclosures and then take an informed call. And one must have a longer term vision rather than just investing in an IPO for listing pops or for short term investing, because I think disappointment comes when the company doesn't list at premium. But just imagine that 3 days back the price discovery would have happened, and then company lists three days from the closing of IPO, and then one expects probably 10-20% of premium in 3 days. I mean, that's so unfair, right? So that's one part. So I think investors must have a longer term view, give time to the management, invest in quality stocks, and must look at the disclosures made in the offer document, which I believe are fairly user friendly. We have even gone to the extent, I think the SEBI has developed a very, very user friendly newspaper advertisement of one page where the key aspects are highlighted. So even all the policymakers, all of us make an attempt at how we can give information at the fingertips of the investors. So in that context, I think some of these golden principles, conventional principles still hold very, very true, and one must not ignore those red flags, even if there is hype or informal messaging done for a particular business or a company.
All right, so that's checklist one should follow before jumping on and investing in an IPO. But last question, really, the participation from mutual funds has been fairly selective, and same can be said about FPI participation as well. What does this signal? And in 2026, do you see a shift in this trend, or do you think this is going to continue?
So mutual funds definitely wants to invest. As we discussed, they are sitting on very high dry powder. So definitely they want to invest. At the same time, I think the average investment by leading mutual funds has been in the range of, let's say, 26 to 28% by numbers. So that means they have been very selective and very, very cognizant of quality and from the lens which they apply. Which is in a way a very, very solid signal that one is not just driven by volumes, but more out of the conviction-led approach. FII participation, of course, has been suboptimal. It is less than 20%. So I think domestic institution and domestic capital is in any case filling that space, be it in secondary or primary. But I think we will have to see more broad-based participation of funds as a whole, because if we see 103 IPOs, 2/3 of IPOs have come up in the range of less than 2,000 crore of offerings. Where the money is going is probably in the other, 1/3 of IPOs. So I think we will have to have more broad-based participation by funds, so that we have more inclusive capital formation taking place at the ground level. And also we support those domestic businesses which have come up to the public listing stage. So that is, I think, probably my, remark to this question, that while mutual funds have been following conviction-led approach and FIIs have been suboptimal level participation, but a more broader participation from funds will probably have more stronger and more broad-based capital formation.
All right. Okay. Got your point. On that note, we are running out of time. Would like to thank you, Mahavir. I enjoyed this discussion, and of course, I look forward to having you more often on our show as well. Before I let you go, wishing you a very, very happy New Year, you and the entire team at Pantomath. Very happy and prosperous New Year, and look forward to more interactions in the future as well.
Wish you the same, Nandita, and to the entire team, and best wishes for New Year to the entire team. Looking forward. Thank you.
Thanks a lot. Thank you. Well, on that note, take a look at the markets. We have, kind of paired some of those early losses. In fact, the Nifty is just about down 6 odd points. Sensex now just about 40 points down. So we are trying to claw back from the day's low. In fact, trying to even break into the green territory. Of course, today is the monthly expiry and weekly expiry on the Nifty. Last expiry, so to say, on the Nifty for 2025. So it is expected to be a volatile day any which ways. But remember, volumes are pretty thin, as is the case every, New Year's. So that's something that, we will be tracking how the Nifty really behaves as we go through the day. For now, we've managed to cut some losses, but let's see whether we manage to break into the green and end the day in the green as well, because after today, there's just one more session to go before we hit 2026. Let's see whether or not the bulls fight back or not. But, in terms of the breadth as well, improved slightly. 1087 advances to 1594 declines. And looking at some of the movers on the index, you have Eternal now. That's the top Nifty laggard. There are some reports, or in fact sources that have told Money Control that Blinkit CFO may have resigned. I think that's one reason why shares of Eternal are under pressure. Indigo as well. After a string of gains, Indigo has once again succumbed to selling pressure. That's the top among the top Nifty laggards. Bajaj Finserv, Max Health, Apollo Hospital, Tata Consumer, Kotak Mahindra Bank, these are among the other laggards for the day. On the flip side, Shriram Finance, that stock top gainer. CARE Ratings has upgraded, the rating, the long-term rating on the counter. Of course, that's the first rating upgrade, or a revision in ratings rather, that it's getting after the MUFG deal as well. Hindalco, M&M, Bajaj Auto, Trent, Adani Ports, Tata Motors, passenger vehicles, these are some of the other gainers. But with that completely timed out on this edition of Opening Bell, thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates. And I'll see you with closing bell at 3 p.m. So don't forget to tune in for that. Have a great day.